In this lecture we are going to analyze a simple example of a market manipulation in the Canadian dollar 30-minute timeframe. This is a relatively simple example that makes use of the wash line principle. As you can see in the chart, there is only about 80 candlesticks visible, which makes the analysis much easier to accomplish because there are fewer things to worry about. If you keep looking back too far into the past, you can run into problems. In number 1 through 4 we can see that price made a lower high and a lower low. This means downtrend if we respect the formal definition, but we don't go out placing trades just because we saw a couple of highs and lows. We must analyze the market a little deeper for that. After number 4, you could attempt to place a sell trade around high number 3, and you would not be entirely incorrect to think that, after all, we have a solid structure in 3. However, I always say that we have to observe how the market behaves when it reaches a level that we intend to trade. That idea alone would eliminate the possibility of a trade around number 3 because the candle right after low number 4 wipes out highs number 3 and number 1. This is precisely the point where this whole structure becomes important for a future trade idea. When price was around high number 3, retail traders were thinking that it would be a good idea to sell the low number 2. Retail traders are often wrong about this, but they cannot really let that idea go because sometimes it works. The problem is not how often breakout trading works. It's the risk management structure around it that is not sustainable. As you can see in the chart, after that massive candle right next to low number 4, those short retail traders were washed out of their positions. That volatile candle also triggers the reverse psychology and bandwagon effect in the manipulation. The von Restorff effect happened in a different way here. It's not the purposeful attention-grabbing candle before the manipulation. In this case it's how obvious the low number 2 seems to be a good short trade idea for the retail traders. The low number 2 is the level that was used as an axis by large traders, so this is where we can draw the horizontal wash line. Observe that the retail traders that were looking to go long in high number 3 got the chance of seeing some decent profit in their terminals. Once again, the problem here is that they don't really have a good place to put a stop loss, and the trade location of this method of trading is poor to say the least. They often get in the market in the middle of nowhere, meaning that they enter not near the edges or reversals, but they enter in the middle of market vectors. It's just not a good idea. After number 5 we can see that buyers have exhausted their accumulated energy, and price starts to fall. Take a moment to notice the difference between how price rises from 4 to 5 and how price falls from 5 to 6. It should be obvious to you that buying pressure seems to be a lot higher than selling pressure. This is something that retail traders simply fail to recognize most of the time. They tend to have a colder look at the market that simply glosses over nuances like that. It's not just about the objective measure between highs and lows. It's also about the way price moves between these points. That can make the difference between a successful analysis and a failed one. The problem is that this sort of thing is not comfortable because it's subjective to a certain degree, and nobody likes the mixture of risk and subjectivity. However, subjectivity in the market is a necessary evil. In number 6 we can see that price fell back to the wash line that came out of low number 2, which was the low that was used as the axis in the manipulation. One of the interesting things about a wash line is that it has a built-in stop loss, which in this case would be the low number 4. Beyond that, this is not merely an arbitrary stop loss. It has a logically consistent motive for being considered a good stop loss. Observe also that we have a well-established uptrend in the chart after number 5. The low number 4 is now a solid market structure, and our wash line is giving us an objective level to trade around the point of ignition of that massive bullish candle that took out the highs 1 and 3. In summary, we are apparently in the same side as the market makers. We have a notion of uptrend, we have a place to put a stop loss and a good place to trigger the trade. The trade you see opened in the chart was triggered in the second time price touched the wash line, which is what happened in number 6, which also happens to be a fractal candle if you analyze this market under the light of the fractal flow strategy. In other words, you would have an extra layer of confirmation here if you used both strategies simultaneously. The target was placed around number 5 to give us a risk-reward ratio of 1 to 6. Let's see how the market developed. As you can see here, the wash line in combination with the contextual understanding of what the market makers were doing pinpointed the most precise entry level possible and a very well planned and simple trade.